Welcome, everyone. Thank you for joining. Today, we're talking about tax strategy that can create immediate cash flow without raising rent, cutting expense, or refinancing your debt. It is called a cost segregation study. In simple terms, cost segregation helps property owner move certain part of the building into shorter tax lives, which can increase depreciation deduction in early years of ownership. Bigger deduction can mean lower current taxes, can mean more cash available for operation, renovation, or even your next acquisition. So this session is designed for real estate business owners. I will keep the language simple, but I will make sure the tax concepts are accurate and understandable. By the end of this webinar, you should understand what cost segregation is, how it works for a property where bonus depreciation fits in, and what question you would ask your CPA before moving forward. Let's start with the foundation. Depreciation is tax rule that let you recover cost of the business or investment property over time. Instead of deducting the full cost of building you just bought this year, the tax law gradually spread that price you paid for as a deduction over many years. So that matters because of timing matters. A deduction today is usually worth more than the same deduction many years from now on. If you can legally move deduction forward, and that may improve your cash flow today. Many owners think of property as a one big item, one big asset. But for tax purposes, that is not always true. A building contains many parts. Some parts are truly part of the building structure, but other parts may be treated more like equipment, fixture, site improvements, and those categories can have much shorter tax lives. They're not 39 years. They are maybe 5 years, 15 years, 20 years. They're shorter. That is the big idea behind the cost segregation, not changing your total cost of the property, but changing which parts of that cost to be deducted in your tax return. So one important reminder though, remember when you buy a building, the land itself does not get depreciated. So when a property is purchased, part of the purchase price must be allocated to land, and that part is not deductible through depreciation. So what we say is, if you bought a building for $5 million, and you can look up assessor's website, it will tell you the land proportion to the whole building ratio, then you can kind of estimate what is the land allocation amount should be. Then the rest of it is subject to play. So what does cost segregation study do? It does an analysis on a building and on its improvement to identify which part of the cost can be placed in shorter life category instead of staying in the long life building bucket. That long life building bucket is 27 years for residential building, 39 years for commercial. But some items may be carved out into the shorter tax life. For example, some item inside or attached to the property may be treated as personal property. Personal property is not your property. It is for tax purposes, identify those property with a shorter life. For example, some items inside or attached to the property may be treated as a personal property for tax purposes, like fixture, cabinet. In tax languages, these are often referred to as Section 1245 property. And these commonly fall into 5 years or 7 years property category under IRS Section 168. It is that asset class allow you to give a shorter life to the property, right? Other items outside of the building, like certain site improvement, may qualify for 15 years property. These are often things like parking area, landscape, and sidewalk, and site lighting, fencing, similar land improvement. The long life building portion is often referred to as a section 1250. So when people talk about cost segregation, they are often talking about reclassifying parts of the property from longer life from section 1250 to section 1245. For residential properties, it can include specific decorative furnishes and a specialty electricity for equipment, removable flooring, appliances, carpentry, detailed of certain settings. All of these site improvement, they become the shorter section 1245 asset class. So why are we caring about that? You break your building down to these sections will allow different tax deduction to come to play. That is the fundamental of cost segregation, just like the name referring to. They're separating your 5 million building into small parts. Part of it write off, part of it continue for long-term depreciation. Now, let's connect cost segregation to bonus depreciation. Bonus depreciation is a tax term saying that you can understand the bonus word is like a big depreciation, is extra depreciation, because it is what came out of OBBBA, right? So that has a big cash flow impact on you. Under IRC Section 168, qualifying property with a recovery period of 20 years or less. So that including your 5 years, 7 years, 15 years, 20 years or less may be eligible for bonus depreciation. That means all of these costs can be deducted immediately instead of over 27.5 years. So why does that matter? Because cost segregation often identifies the 5, 7, 15 years property. Those short life assets are generally within the 20 years or less window, so which means that they may qualify for bonus depreciation if other rules are met. For 2024, the bonus depreciation rate is 60%. So let's say if you have $100 that qualifies for Section 1245 class, then 60% of that you can write off. For property placed in service after January the 1st through January the 19th, 2025, remember President Trump became president on January the 20th. So he made a clear point saying that, well, even if you bought property in 2025, but because you bought it before I become president, so you are not going to have the bonus depreciation as 100%. Only 40%. So you see, there are 40% for 2025. But for after that, with OBBBA, you can actually have 100% bonus depreciation. So in Chinglish, that means the timing of acquisition and the placed in service date can materially affect the first year tax outcome. If a property owner buys or improves the property at the right time, the front-loaded deduction can be significantly larger. That said, bonus depreciation, does not automatically make sense in every cases. If your taxable income is low now, but likely higher later, if you expected to sell your property soon, the decision deserves a little more thinking. Not a cookie cutter for all of you, but making sure that you know there are other considerations. So let me give you a very simplified example to make a point why bonus depreciation through cost segregation is so amazing. So assume that you bought a property for $5 million. Assume that the land is $1 million, so we got $4 million depreciable basis. Am I right? So with that $4 million depreciable basis, if I don't do cost segregation, I just goes, oh, yes, here my CPA. I bought a building and 5 million, 1 million land, 4 million building, and here you go. So your CPA go ahead, divided 4 million by 27.5 years because that classified as a rental building. Once it's divided, your deduction is 145,000. So let's say if your income is 145,000, then of course your deduction is 145,000, then it's netted out, you don't pay taxes. But what if, because you bought a $5 million building, you actually made a $5 million net profit? Then your $145,000 really just reduced your $5 million income by that amount. What if you did cost segregation and with CCPA business advisor in Toronto, Canada, and a Toronto, Canada company is doing cost segregation for U.S. company. And if you're interested, and I will introduce you to Karen, and she will do the cost segregation for you, give you a report. Her report will identify 800,000 of 5-year property. So she break down your building. So 800,000 belongs to 5-year property, 200,000 belongs to 15-year property. That is a land improvement. The remaining 3 million stays with a long-term building category. So that was her cost segregation study result. If this building qualifies for 100% bonus depreciation because it was bought after President Trump, then the owner will be deducting how much? It is 800,000 plus 200,000, $1 million on the 100% bonus depreciation. Then the $3 million is going for 27.5 years. That is 109,000. So together, this business owner bought property after President Trump became the president and did cost segregation with Karen and getting a $1,109,000 deduction for that first year. Comparing to what was the number if we didn't go to talk to Karen, that number would be 145,000. Let's say if the owner need to pay federal and state combined taxes for 30%, and you know how much this owner would save? And this owner will save $289,000 on taxes. When does this strategy make sense in the real world? You may say that, oh, Ying, I bought a property. Should I do it? Generally speaking, the larger the building and the larger the improvement project you have, the more likely a study will justify a cost. Here, normally, you can find people do the cost segregation service for you. It ranged from $6,000 to $10,000, anywhere in that range. CCPA, business advisors, provide cost segregation study report and for less than $2,500. So that is a value that on the market as well. So you can decide where to go about doing the cost segregation. Smaller properties still benefit from cost segregation, but paying for $8,000 for it may not be a good idea. But paying for $2,500 or less, that would make a lot of sense. So it is really about comparing how big the property is, then what do you want to invest in the tax saving. If you spend $3,000, gets $289,000 tax saving, that's no brainer. You should just do it without even ask that question, right? It is often most valuable when you have taxable income really high. If you know you made a lot of income, you pay a lot of taxes, you bought a property, you have to do cost segregation. And if you are in the lower tax bracket and not really paying taxes at all, then you maybe don't need to do cost segregation. You want your deduction to slow down to benefit you to the future, because in the future, maybe you are making more money, right? So your expected holding period also matters. You know, how long you're going to hold the property. Cost segregation often improves the near-term cash flow, but some of that benefit can come back as a cost to you later if you sold your property too quickly. So that is a consideration. I want you to know that there is a thing called depreciation recapture. So when you are, when you sell your building, the depreciation you took from the past, they're recaptured back to be taxed on the regular income tax. So those are the things you want to, do a modeling with your CPA, with community CPA. We help you. We're specialized in real estate side of development. We have teams that who knows exactly how to work on your cost segregation and on your application for tax return and plan out which year you want to sell. Then we can project that out, tell you when you sell what is the tax would be. So it is a thing that you want to apply to yourself, and don't just blindly goes, oh, my neighbor did cost segregation, I want to do it too. No, maybe your neighbor did it, he needed it, and you don't. But if you do cost segregation, now you know that you can go for a CCPA business advisor and go get your cost segregation with a economical cost for this important analysis. The best time to do a study is often near the acquisition, okay, near the completion of construction. And normally before you wrap up your renovations and you paid your bills and you before you file your next tax return, this is the best time to do your cost segregation because the record need to be submitted to to do analysis. Then the report would come out, then you receive the report, you submit it to tax preparer because those need time. Normally for CCPA business advisors, it takes them from a week to 3 weeks to get the report done. So you want to give enough time that don't run into the tax due date. That would really kind of mess up your savings, right? You want to get your tax saving immediately after you purchase your property. What are the few important cautions that Ying will give you? Based on my experience, the cost segregation does not mean the whole building can be immediately deducted. So don't confuse cost segregation from writing out your building. Only qualifying shorter life components can be accelerated, right? The building structure is still going to stay long term. The rental property is for the residential, so it's 27.5. But let's say if you bought a shopping mall, you bought a plaza, that would be 39 years for that long-term category. So the other thing I want to mention to you is that the land is never depreciable. So don't forget to subtract. Study cannot turn land into depreciable asset. It doesn't matter who does your cost segregation report. The other item I want to mention to you is this area does attract IRS attention, especially the allocation. So IRS want to know why you are doing it in such way. That's why for cost segregation, it is just such a smart thought for you to do it with a third party. You don't want to be yourself doing cost segregation study. Even if you are so smart, your AI works so wonderfully for you, can do everything for you. So you can come up with something like cost segregation report, but it is still you. And what you want the third party cost segregation report in your hand, submit it to the tax preparer, have them prepare the tax return for you. So it is very important to have that not being your opinion or being the third party opinion. And normally when you hire the third party, they will be very professional in terms of presenting. They pull out references, they do all the studies to come up with what they say of the categories are. So the strongest study relies on the architectural information and your site data, other records. So those are the work need to be done before the report to be final. Finally, As a business owner, you need to understand the depreciation recapture. If you accelerate depreciation today, later you sell the property for a gain, some portion of that gain will be classified as a regular income subject to higher income tax rate. Not all of them be the capital gain. If what I say just brings complexity to you and not making you super clear, because it is not a super easy one sentence area in textbook. So what I would recommend you is to, engage someone. If you engage our firm, you go onto our appointment button and make appointment with our tax special people. That is, 45 minutes and we answer your question, we lay it out. So there's no way you don't understand it. But in terms of knowledge spreading, right, this time, right now, we want you to know the difference between the Section 1250, Section 1245. Remember, Section 1250 is a bigger number, so that is a longer life term, but the Section 1245 is a smaller number compared to 1250, so it represents the shorter life. You want other people to do these cost segregation job for you, split your property from 1250 to 1245, then your 1245 can be written off immediately. But if you are going to sell it, or something happened, you have to sell it, that's okay. It's just a recapture. So recapture is recapture, just means that you wrote it off. So now you have a gain selling your property. They're bringing what you wrote off back to classify that as a regular income. So this area, cost segregation area, does attract the IRS attention, especially when allocating seemed to be in disagreement with the auditor. Okay. That doesn't mean cost segregation is wrong. It just means that the auditors, the IRS, want to understand that you got a very good support. So how a taxpayer come out to be strong, say that I have a good support. So that third party made cost segregation report, it is your shield. So in summary, cost segregation is a tool that can unlock immediate cash flow by accelerating deduction, accelerating depreciation on qualified parts of the property. For the right owner, the benefit can be substantial, especially when bonus depreciation applies, right? OBBBA gives 100% deduction, not that 40%. But it is not automatic, right? Nor is it one size fit all. So the value depends on the size, the type of the property, your taxable income, your holding period, and the purchase placed in service date. So please don't buy anything. Of course, it's too late. From January the 1st, 2025 to January the 19th, 2025, that would ruin all of these things we're talking about. You only qualify for 40% of that deduction instead of 100%. If you own or are buying a commercial property or mixed use multi-unit rental property, the practical next step is very simple. Ask your CPA to model the benefit. Ask it. So compare the near-term tax saving against cost of the study, against the potential recapture when you exit, when you sell that property. If the number works, cost segregation may be the smartest way to go about doing your taxes this year. With that said, we give you the strong dose of cost segregation. You know how to work it out and you know why you need it. So I hope that you will start thinking your 2026, the year is not over yet. Why not buy a commercial property? Enjoy the cost segregation. OBBBA, this law would at least last for President Trump's term. Right? And here is our community CPA website. You can book appointment with us and we will tell you what to do on the cost segregation. And like I said, these two individuals that I circled on the screen, and they are tax experts in our firm. Of course, you can also tap into my time. When you go to the appointment page, you will see my smiling face on it. You can click it, book my time. And here is the two books that I wrote already, and it's on Amazon. You can, if you're interested in starting up a business or growing your business, these two books give you the answer. Last but not the least, this is our YouTube channel. And when you come to our YouTube channel, you'll find all of the topic that we talked about is in here. You can search them by category and you can search them by keywords. So you will see all the ones that we talked about. Thank you for tuning in. This webinar is for education purpose only. It's not tax, legal, accounting advice. Cost segregation outcome depends on the fact, documentation timing, and your overall tax situation. So review any decisions with your CPA or tax advisors. Come to Community CPA. We welcome new clients. Thank you very much.